So income statement. What is an income statement? So an income statement is one of the three important report cards. There are more report cards than these three, but there's like a balance sheet, income statement, and a statement of cash flows. Those three are very important, as we've talked about in other videos. But in this video, I'll talk about the income statement. So the income statement has several kind of names. So some call it an income statement, some call it a profit and loss statement, some call it a P&L, some call it a statement of operations. But it sort of just shows the profit over a period of time. The way the income statement is built up is that it has a top part where you have the sales and the revenue, then it has an expenses part, and then it has a profit part. The profit part can have different names too. So some call it net profit, some call it profits, some call it net income, some call it earnings, some call it bottom line. But it's sort of the same, right? So that is like the way an income statement is structured. So as an example, when we look at an income statement, the problem with it is that if I just look at the net profit, and I'm like looking here, and there's a number 6, then I don't know if I'm happy or if I'm sad with the number 6. So I need to, when I have an income statement, to go and look at the sales revenue. So if we imagine that the sales and revenue was 1,000 and the expenses were 994, then I might not be that happy that I only got 6 in net profit. On the other hand, if I had net profit of 6 and my sales revenue was 10 and my expenses were 4, then I might be more happy with my net profits. So at an income statement, it's not enough just to look at the net profit. We need to look at the sales and the revenue, and then we need to look at the relationship between the numbers. So we need to look at the relationship between the sales and the expenses. So that is actually a very, very important part of the income statement, because you see the relationship between 1,000 and 994 and the relationship between 10 and 4 is very, very different. So when we look at an income statement, it's very, very important to look at relationships between the numbers. And then it's very important to have a period, like several periods, several income statements, so we can see the trends. So we can see how did we do with this relationship between the sales and the expenses last year, last month, last quarter, so that we can compare, are we getting better? Because if we're getting better, right, it might be that, okay, so we had like the 1,000 in sales and 994 in expenses. But then the next year, the expenses is going down because we just started, right? So then we are happy. But if it stays with like very high sales, very, very high cost, then we might be angry. So looking at the income statement, we need to be aware of the relationship between the revenue and the cost, not only be fixated at the net income at the bottom line. An income statement has a start and an end date. So most companies will have an income statement that starts on January 1st and then it ends at December 31st. Larger companies have income statements that are every quarter. So that means like if you buy stocks in a company, then they will release an income statement every 3 months. And the income statement shows what happened with the revenue, expenses, and net profits over that period of time. So especially like if you're like into short-term rentals or you have a company, I had an insulation company, then that one is very much dependent on seasons. Then it might be cool to have quarterly or monthly income statements, because I don't want to compare bananas to bicycles. It's the same thing. I can't really, it doesn't really give me optics if I just have an income statement for an entire year and then the next year I'm comparing that. It doesn't give me that many tools in my toolbox. So it's much cooler to have like an income statement where I can see like what happened in June, what happened in July, what happened in August. If like I'm doing short-term rentals, or if I'm doing the installation, it might be cool to have one that is like October, November, December, January, February, March. Because then the next year I can compare month to month. How did we perform year on year on that month? If that makes sense. Because we have different things. But that is like the gist of an income statement. So it has a start and an end date, and it shows what happened over a period of time. In most countries, when you follow the law, then you're doing some sort of accrual accounting. So accrual accounting, when we're looking at an income statement, means that revenues and expenses are recorded when they're earned or incurred, regardless of when cash is exchanged. So that means when I send an invoice to you, then my accounting system will go in and say, hey, Palle, you made some money, so my net income goes up. But I haven't received the money from you yet. The same thing when if you send me an invoice, then I need to put the invoice into the system, but I haven't paid you yet. But the net income, like the income statement, will still show the losses and the gains, even though you haven't paid me and I haven't paid you. So when we're doing the accounting, then in most cases, the numbers in an income statement doesn't reflect that cash has been exchanged. So you can have a profit, but no cash because the customer haven't paid you yet. And then on top of that, that gives some problems in like Denmark for some companies, because if you send out a too big invoice, then in Denmark you need to pay sales tax. And the sales tax needs to be paid regardless if the customer have paid you or not. And then some companies go out, found like very close, a very, very good, awesome big deal, right? And then, they do the job and then the customer doesn't pay them. But because they've sent the invoice, then the accounting system and the law says that then you need to pay the sales tax. And then that actually makes the companies go bankrupt. So the income statement doesn't show if cash has been exchanged. The reason why accrual accounting is used and like is by law, some of the things, I know that a lot of small companies, they're very like fixated on putting in the invoices, right? Because like when you need to send the invoice, the net income goes up, right? Because then you have revenue. And then a lot of companies, they don't put in the invoices they get, right? So they don't put in their bills until they have the money to pay the bills, right? And then it gets kind of screwed, and that is not in their favor, right? But the thing with accrual accounting is that this method provides a more realistic view of a business financial health over a specific period, aligning with generally accepted accounting principle, GAAP. Because again, like I need to put in the net income not when I receive the cash, but when I invoice it. That gives me like some optics, right? But it doesn't give me cash. The same thing when I receive an invoice, I shouldn't put it in when I pay it, right? I might pay it in 2, 3, 4 months, right? But I need to put it in when I receive it, because then I can see, oh, the cost was incurred here. The income was incurred here, right? But when was the cash exchanged? So the cash exchanged is something you would look at the trend over year and year. So I'll get back to that in a different video where we talk more about that, the principles behind that. So you record revenue when you deliver a goods or services. So when I send you an invoice, that's when I record the revenue. That's when all the Danish accounting systems will record the revenue. So when I go and I look at the graph, I made some money, even if the customer hasn't paid yet. And you record an expense you incur when you incur a cost, even if you haven't paid the bill yet. So these numbers are actually inside another piece of paper. So we had a balance sheet I was talking about in a different video. So the balance sheet has three parts. So it has assets, that's the company's things and stuff. Then it has liabilities, that's what the company owe. And then it has owner's equity, that's what the company owns. Under assets on the balance sheets, we have something called account receivables. So account receivables are all the money where I've sent you the invoice, but you haven't paid me yet. So that's under account receivables. So the number here on the balance sheets kind of like illustrates the money that is on the income statement. So at the bottom of the income statement, we have the net income. But if I go look at the balance sheet, I can look at the AR, the account receivable, and then I can see, okay, so I haven't received the cash for those invoices yet. So because that is very important when you're looking at the income statement, right? Because if we don't have cash, we can't pay our bills, right? So it's very important to always keep the AR in mind when you look at an income statement. So the income statement alone is worthless. We need the balance sheet so we can go and check, so how are we doing with the accounts receivable, the AR? Under assets, we can also see our inventory. Because sometimes then on the income statement, there's like, the expenses are very high, right? But maybe it's because our inventory is going crazy and we can't control that. But we don't know that just looking at the income statement. So we need to go and find the balance sheet and then look at our inventory, right? Because if we're looking at the trend from year to year, then the expenses might be going up like crazy. Like like I showed before, like you have 1,000 revenue, 994 in expenses. But maybe it was because someone ordered too much inventory. So we need to go look at the balance sheet and then we can see like, is inventory part of this thing? And then we have under the liabilities, the money we owe. So that is like another thing that can like go and do things, right? So we have the account payable. So that means like invoices, like you have sent to me, but I haven't paid yet. So that is one that like goes in and affects cash too. So there can be like two problems with this one, right? It's one thing is like a lot of companies, a lot of small companies, they don't put in the invoices they can't pay. So they don't put those in the accounting system. So the accounting system kind of get screwed, right? But we sort of want a balance between the accounts payable and the accounts receivable, because these three things are the things that go in and affect our cash flow. And if we don't put in the invoices that we haven't paid or can't pay because we don't have the cash because the customers didn't pay us over there, then you see that something is happening with this income statement. So even though it shows that we are making a lot of money, then maybe the customers haven't paid us. Maybe we have incurred a lot of expenses, but we haven't paid for the expenses yet. So the income statement is not like a balance sheet, but it has a date. So every income statement, to summarize, has a date because it shows like as of, so it shows like a period of time. So this is the one from Enron. So this one shows the entire year from 1999 to 2000, or 2000 to 2001. An income statement is a map. So it shows a map of the income, shows a map of the expenses, and it shows of the revenue, and then it shows a map of the net income. The income statement is a movie, you can say, right? Because it rolls over a period. The income statement shows profit, and profit is a theory because I can't go out and spend my profit. So that means the income statement is not the entire truth. So the income statement alone is sort of fake. Because, again, profit is a theory, right? Because the income statement will show I made a lot of money, but that doesn't mean that the customers have paid me. And I can't go down to McDonald's and say, hey, I want a burger. I'm going to pay you with my profits. the guy down at McDonald's is going to look at me like, Palle, you're a crazy person, right? I'm not giving you a burger, right? We cannot spend profits, right? We can only spend cash. So it's very important to track the cash, not the net income, because not net income doesn't mean that we have any cash. When we look at the balance sheet, then the net income from the income statement goes under earnings and cash goes up here. These two things are not the same. That's why at a balance sheet that cash is up here and equity earnings is down here, right? So they put them as far away from each other as possible. Cash does not equal earnings. Profit is a theory, cash is a fact. Earnings do not equal cash. I'm stressing this, right? Because this is very, very important, right? It's a huge misunderstanding when people look at these income statements, right? So when I look at the income statement and I look at the timeline, right? Then to summarize, income statement shows something that happened over a period of time. An income statement is a theory. It's a movie. And that's why it's fake. Because the income that it shows is theoretical, right? Because we don't know if the customers will ever pay us. We don't know if we can pay the bills. The way it relates to the other sheets is that we have the balance sheets, that's the map of our assets. Then we have the income statement, that is like a theory of the profit we have in our company. The net profit at the income statement is the same number as we have on the balance sheet. On the cash flow statement, we have the cash, and the cash on the cash flow statement is up there. They are not the same, right? They need to be kept as far away from each other as possible. And because the income statement doesn't show the cash, right? You can have a lot of profit, but no cash, right? Then the income statement in itself is not very useful. An example of what I just said with numbers. So if we have 10 sales revenue and we had 6 in expenses, then we would have 4 net profit. So 4 net profit goes under owner's equity over there as earnings. With the cash flow statement, we can have a starting cash of 0. Then we can have 4 in OFI cash, and that means like our ending cash is 4. Then we can put that under assets. Usually this never happens. Right? They're very rarely the same. But as a business owner, we need to make sure that our cash flow is at least as big as our net profit or net income or bottom line or earnings, right? We need to make sure that we have the cash, because if we don't have the cash, then we can't pay our bills. So a balance sheet is a screenshot of a date, what happened, how did it look at that date. A balance sheet is a theory, and that's why it's fake. The income statement shows something that happened over time. So it's sort of a movie. What happens on an income statement is a theory, and that's why it's fake. A cash flow statement is a movie too. Cash is a fact. So in the next video, I'll talk about the cash flow statement. So we'll go through that one. In the accounting report cards, we had the balance sheet, we had the income statement, and now it's time for the statement of cash flow, which is like the one that people almost always forget to talk about. If you're new to the channel, subscribe to the YouTube channel, give it a like or dislike, become a member of our Treasure Hunter Entrepreneurship on the siggiway.com. Else, that was all for me. thanks for watching. Write what you think about this thing, right? In the comments below. Thanks for watching. Have a wonderful day.